Hello there again. This is the second part dedicated to the Bollinger Bands indicator on binary options trading, and we discussed so far the Euro-US dollar and the way, or one way to use the Bollinger Bands. This is the most common way to use the Bollinger Bands indicator. We use it on the daily chart, and the idea is to wait for the market to go and pierce into the upper side of the Bollinger Bands, on the lower side if there is a bearish trend, and then to simply wait for the market to come at the middle Bollinger Bands or the EMA. So this is the break. This is the break that we needed. Then the market comes into the EMA. We buy a call option, having in mind the daily time frame. Then the market comes again to the EMA, we buy a call option. And don't be fooled about the fact that this EMA here has not really been touched. This is a dynamic factor. Namely, it will change a bit the previous values based on the current ones. So it could be very well that at that moment of time the EMA was, or the price hit the EMA. But because the market keeps moving, then the EMA slightly changes. That's one of the reasons why you should use, or why I recommend using an EMA when compared with an SMA. Again, an EMA represents an exponential moving average, and an SMA is a simple moving average. So instead of simply averaging the closing prices of the previous 20 candles, for example, an EMA will be closer to price. It will adjust lagging time. It will have less lagging time. So that's two trades, and that's it. In this case, it happened that the trend was really strong, but in other cases the trend may not be so strong. So two times and out of there, of course, respecting the time frame. So here, if we trade with end of week expiration date, looking for minimum 4 days ahead of us. End of month if we are in the middle of the month, and so on. Another way to use, let's go here. This is the Australian dollar US dollar on the 4 hours chart, and I took the liberty to put the Bollinger Bands on the screen. Again, what do we need? We need a break higher in this case to pierce through the upper Bollinger Band, and then simply wait for the market to come into the EMA one time. We buy call options. One time. Comes to the EMA for the second time, we buy call option. Now mind the time frame here, because this is, we buy a call option here. At the closing of the candle, you wait for the candle to close. And this comes on the 4 hours time frames. So one time here, and that's it. And then you wait, we simply wait for the market to go and close beyond the opposite side of the Bollinger Bands. Namely, we still have a push higher, we are not interested to buy call options anymore. Then the market comes here, let me take this one so you would see better. Then the market comes here, face to break, closes below the Bollinger Bands, below the lower Bollinger Band, and then it goes all the way to the EMA. That's the moment we want to go and buy a put option. One time, still continues, second time, and that's it. That's it for this move. You wait for the trade on the other way around. We wait for a close then beyond the upper Bollinger Bands here. It's no close below the upper Bollinger Bands here. It is kissing it, but it doesn't close beyond. We have a look here, this is a close, we buy here a call option, we buy here another call option, and that would be pretty much it for the whole trip. This is not a close into or below the lower Bollinger Band, so the bullish trend is still in place, but we have no interest to trade on the bullish trend anymore because we already took our two trades. And then we simply wait for such a close to come, and so on. You continue with the analysis, but only on this 4 hour chart on the Australian dollar US dollar, using that simple principle, we have 6 trades that turned out to be profitable if we respected the money management and not the money management, and the correlation between the expiration date and the time frame, or between the time frame and setting the expiration date. Now this is just another example based on the one on the euro-US dollar. As I mentioned, you don't need to be greedy. That's the biggest danger of them all in trading in general. Because we as human natures, we want a quick profit, if little or no effort is if possible, and as much as possible. Well, on the long run, you're going to be wiped out if you don't think, or if you don't change this kind of mentality. What we do want, or what we should want from the market, is an opportunity to have a fair chance. Namely, the market may simply not move at one moment of time. It's not always that the market moves. Then we have to look for the best possible place for our striking price, and then to set the most likely expiration date to give us an edge ahead of the market. After all, it is a game of probabilities, right? But smart traders will always have more to say in such a market, and of course will end up making a profit. But so far we discussed one way of using the Bollinger Bands indicator, but like it or not, there's another way. The Bollinger Bands, or the very first idea of John Bollinger when he created the bands, by the way, a great mind, John Bollinger, was to measure a security's volatility. What does it mean to measure the volatility? To find out when a strong move is about to come. That's the reason for the upper Bollinger Band and the lower Bollinger Band. If you go back in classic technical analysis, then you'll find out that the middle Bollinger Band sometimes it's not even part of the indicator. The volatility curve, or if you want, the volatility channel, is given by, or it rests between the blue and the red lines here. How to use it as a volatility indicator? The market spends most of the times in consolidation, like it or not. Even here on the 4-hour chart on the Australian dollar, US dollar, if you check the time frames, or if we measure effectively, is what? From the 19th of July, and now we are almost in October. So for all these months, August, September, October, almost 3 months, the market didn't really go somewhere, correct, or anywhere. It stays at the same level. So the market consolidates, but sometimes when it breaks so aggressively that you don't know what really happened. And to measure that, it means you measure volatility. There are various ways to measure volatility, starting with the average daily range, and then to put on a logarithmic scale for the rest of the week the difference that the market did in travel. We won't get into such a concept here, as we still look for basic ideas, but maybe in the future we'll have the chance to discuss that. With the Bollinger Bands, it's very easy. When the two bands, the upper Bollinger Band and the lower Bollinger Band, shrink, or the distance between them, or the so-called volatility channel shrinks, the market is about to implode. Take a look here. This is on the Australian dollar, US dollar. We simply measure the distance between the lower Bollinger Bands. Let's make it a bit bigger. Let's change it like this. Then let's clone it. And this is what happens. This is what happens when the bands shrink. Look at it. So the market consolidates, the bands shrink. We expect an imminent move. It is a 4 hours time frame. So the move is not that imminent in the sense that you know it will come, but it still took something like one trading day or so, and then the market jumped. Now that's volatility trading. You look for the volatility, it jumped. The moment that it broke on the other side of the channel, you simply go with the flow, with a call option, setting as long as expiration date as possible. Why? Sometimes the market, out of this volatility channel, they make a strong move here only to collapse in the opposite direction. If that happens, so we go with a call option here. If it so happens that the price moves in the direction and closes below the lower Bollinger Band, we reverse with a double trade, for example, with a call option, because the first spike was fake. But the volatility bands here, they didn't lie. Now, how to use it moving forward in time? Well, you can use it as a proxy. Go back on historical levels, go back as much as possible, and on historical level, and find out when a currency pair, the distance is not the same on the currency pair, because volatility differs on various currency pairs. So find out on a currency pair the distance between the upper Bollinger Band and the lower Bollinger Band ahead of a strong market move. And you see that typically, I don't know, let's assume that this one is an appropriate one, and we simply measure it. Let's go with, so this is the distance. We take it and measure it. Is this? No, this is bigger. This is still bigger. This is still bigger. Actually, this was quite good. No, still small. But anyways, so we wait for a consolidation that will be as small, or the distance between the upper Bollinger Band and the lower Bollinger Band will be so small or even smaller, and then we simply trade or expect a break given by Bollinger Bands as a volatility indicator. I hope you enjoyed this one. I really did. Moving forward, we'll look to the RSI and two ways to trade with the RSI. I know it's the most popular oscillator this time, not a trend indicator, but I can guarantee you that there are some tips and tricks you'll want to know. Bye bye.